Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. I'm chatting with Ricardo Smith. He's Chief Investment Officer at Absa Investments. Ricardo, I appreciate the time today. I think if we go back to the beginning of the year, we were quietly optimistic in terms of the South African consumer for the year ahead. Things have changed, but I mean, to be clear, even when we got the Q1 GDP data numbers, clearly showing that we weren't out the woods. I mean, the number that stood out to me perhaps was consumption, largely flat. And then, of course, second quarter, we've had the war in Iran, we've got higher fuel prices, higher rates. It's been probably a tougher year for consumers than last.
No, 100%. And, the issue with economic activity, that structurally GDP has not been outpacing population growth. So on a per capita basis, we have been getting poorer. And then you look at the sectors like mining, manufacturing and construction, and even worse when it comes to construction, they have not been doing well. And these are labor absorbing sectors. And that has translated to structurally high levels of unemployment. We're still sitting above, pre-COVID levels, and confidence is low, spending is low. So it has been, quite a tough environment for consumers.
It has, and it's not looking to get better in a hurry. I mean, GDP for the full year, maybe a little over 1%. Talks we might even get another rate hike from the MPC, and limited income growth for the consumer. It's going to be a tough rest of 2026.
No, for sure. There are, however, some positive shoots, that are worth noting. The first is that global oil prices have come down. There is a peace deal between the US and Iran. It is a volatile peace deal because, every week there is something that potentially changes. But by and large, oil prices are behaving. It takes a while for that to filter through to local inflation. The interest rate environment, we've seen one hike this year off the back of this elevated oil prices. We may see, flat policy regime from here on, and even potentially cuts next year or even the latter part of the year. And relatively speaking, we are coming from a couple of rate cuts over the past 18 months. So there's positives there. Debt, has been a bit more stable. Debt to disposable income has come down over the years. Two-pot withdrawals, coming in, and seen a lot of debt repayment, a lot of essential spending, a lot of pressure relief. So there are some green shoots. And then from a government perspective, we are seeing fiscally, they are allocating a lot more to economic development than they have in the past. And we're seeing that debt containment story coming through and lower inflation targets. And in fact, even now, inflation, as elevated as it is, it's 4.5% and expected to come down. So there are some green shoots, but these are structural issues. And so they do take quite some time to actually impact the men on the ground.
And I like your point around that 4.5 inflation. It's high for the new target, but if we'd been talking around 4.5% a year ago, it would have been smack in the middle and we would have all been comfortable with it. It is circumstances. You mentioned that 0.25% rate increase, and we had a lot of decreases, a year and a half of rates coming down, and a quarter point. I mean, it does hurt. It's about 240 Rand per 1.5 million of bond. So there is some pain there. The flip side, of course, is that consumers as savers, if they've got the ability to save, can get a slightly better rate potentially as well.
No, 100%. So there is better rates, but I do think that, the MPC is trying to move away from that environment where cost of debt, is excessively high. So there is positive correlation between long-term inflation and long-term interest rates. And so, they will be a lot more cautious about inflation now as they try to anchor inflation with the new target of 3%. But once it is well anchored, in the long term, we would expect, cost of debt to actually come down quite significantly. So there's quite a lot of long-term positivity that can come through from all the structural reforms and policies that have been put in place. It just takes a while for us to get there.
And that anchoring is so very, very important. And I appreciate it's a difficult concept often to get our heads wrapped around. But if as consumers we kind of anchoring around the 3%, then our salary increases are lower. And it all just brings that inflation number down and ultimately the cost of the debt down, which actually benefits us at the same time.
No, 100%. And the real thing that we should be tracking is real purchasing power. And that's what they're trying to control. And most of our major trading partner economies have significantly lower inflation target, and they've been having inflation troubles of their own. If you look at Well, with the exception of China, which
Sure.
has been quite low. If you look at the US, you look at Europe, you look at the UK, they've had very high levels of inflation in the last 3 to 4 years. So, that purchasing power, and we've seen that coming through in rand resilience. Most of our inflation is imported through our currency. And so it is important to maintain those real rate differentials and ensure that we're not losing value in our rand faster than what is happening, say, to the dollar or the euro or any of our other trading partner economies. And importantly, we have seen labor, well, analysts were the first to actually revise their expectations of inflation lower, but we have seen some follow through in terms of consumers, in terms of labor, and in terms of business. A bit of a laggard where consumers are, but inflation expectations have come down to 4.5% there, with analysts, kind of anchoring around 3% and labor unions around 4%. So we are trending in the right direction.
We are trending in the right direction. And I take your point around global inflation. I think the US has been 5 years outside of their 2% target. We've been outside of our target for a month and we're starting to worry. We'll leave it there. Ricardo Smith, Chief Investment Officer, Absa Investments. Appreciate the time. This podcast is brought to you by Absa Investments. Invest in more certainty to navigate volatile market conditions.